Volatility skew and volatility smile are important concepts in options markets because they describe how implied volatility varies across option strike prices. Traditional option pricing models often assume that implied volatility is constant for all strikes, but real-world markets rarely behave this way. Instead, investors observe systematic patterns in implied volatilities that reflect market sentiment, demand for protection, and perceptions of risk. Understanding these patterns is essential for interpreting option prices and identifying relative value opportunities. The program emphasizes that volatility skew and smile are not merely theoretical observations. They influence option valuation, hedging decisions, and the selection of appropriate trading strategies across a wide range of market conditions. A volatility smile exists when options with strike prices far above or below the current underlying price exhibit higher implied volatilities than at-the-money options. When plotted graphically, implied volatility across strike prices forms a U-shaped pattern resembling a smile. This phenomenon is commonly observed in certain asset classes where extreme price movements are perceived as more likely than predicted by standard models. Higher implied volatilities increase option premiums, reflecting the market's expectation of larger potential price swings. The volatility smile highlights the limitations of constant volatility assumptions and demonstrates that market participants assign different probabilities to various future price outcomes when valuing options. Volatility skew is a more common pattern in equity markets. Under a skew, implied volatility tends to rise for increasingly out-of-the-money put options while declining for increasingly out-of-the-money call options. This asymmetry reflects investor demand for downside protection. Equity investors often purchase out-of-the-money puts as insurance against market declines, driving up their prices and implied volatilities. Conversely, demand for out-of-the-money calls is generally lower, resulting in lower implied volatilities. The resulting downward-sloping pattern is known as the volatility skew. Understanding skew is particularly important because it affects option pricing, hedging costs, and the attractiveness of different option strategies in portfolio management. The program also introduces trading strategies that exploit deviations in volatility skew from historical norms. One example is the risk reversal, which combines long and short out-of-the-money options on the same underlying asset. A long risk reversal generally involves purchasing an out-of-the-money call while simultaneously selling an out-of-the-money put, often with a delta hedge. This strategy reflects a view that call options are relatively underpriced compared with puts. Conversely, a short risk reversal expresses the opposite view. Such strategies focus primarily on relative implied volatilities rather than outright market direction, illustrating how volatility patterns themselves can become sources of investment opportunity. Topic applies the option strategies studied throughout the topic to practical investment scenarios. The focus shifts from understanding individual strategies to selecting appropriate strategies that align with investor objectives, risk tolerance, and market expectations. Portfolio managers must evaluate whether the goal is income generation, downside protection, volatility exposure, or directional positioning. The curriculum emphasizes that option strategies should not be chosen in isolation. They must be linked directly to the investor's circumstances and outlook. Successful application requires combining knowledge of payoffs, risk exposures, Greeks, volatility characteristics, and market conditions to construct positions that effectively address specific investment challenges. Covered calls provide an example of an application-oriented strategy. Investors holding a stock with limited expected upside may sell call options to generate premium income and modestly reduce portfolio delta. This approach is particularly useful when cash generation is a priority or when the investor expects the stock to remain relatively stable. The trade-off is that future gains above the strike price are forfeited. The program highlights scenarios in which covered calls help investors monetize existing holdings while maintaining ownership of the underlying asset. Such applications demonstrate how options can be used to modify portfolio characteristics without requiring the sale of the investment itself. Protective puts, collars, and straddles represent additional applications tailored to different market views. Protective puts are appropriate when investors seek to retain upside exposure while limiting downside risk. Collars are useful when preserving capital is more important than maximizing future gains because they establish both downside and upside boundaries. Straddles are suitable when investors expect substantial volatility but are uncertain about direction. Each strategy reflects a distinct combination of risk and reward characteristics. Selecting among them requires careful assessment of market expectations, option costs, volatility conditions, and portfolio objectives. The curriculum emphasizes that strategy selection should always be driven by investment goals rather than mechanical preference. 4 candidates, volatility skew, volatility smile, and option applications represent the culmination of the option strategies topic. These topics integrate concepts such as payoffs, Greeks, volatility, and synthetic exposures into practical decision-making frameworks. Understanding volatility patterns helps explain why options are priced differently across strikes and maturities, while application-based analysis demonstrates how those options can be employed to achieve specific portfolio objectives. Whether the goal is generating income, hedging risk, managing volatility exposure, or expressing market views, options provide flexible tools for tailoring risk-return outcomes. Mastery of these concepts enables investment professionals to evaluate option strategies systematically and recommend solutions consistent with client needs and market conditions.